Question 1. The performance metrics show a significant increase in claims related to unforeseen site conditions on projects where the surety has issued both performance and payment bonds. A principal on a large commercial project is requesting an extension of time and additional funds, citing these conditions as a basis for a potential default. What is the surety's most appropriate course of action to uphold its obligations under the bonds and manage its risk? Option A. Immediately approve the principal's request for additional funds and an extension of time to avoid a default, thereby protecting the obligee from project delays. Option B. Agree to the principal's request for additional funds and an extension of time, but only if the obligee agrees to release the surety from any further liability under the payment bond. Option C. Conduct a thorough investigation into the principal's claim of unforeseen site conditions, reviewing all relevant documentation, and assessing the impact on project completion and the obligee's exposure before communicating a proposed resolution to the obligee. Option D. Deny the principal's claim outright, advising the principal to proceed with the original contract terms to avoid any additional financial commitment from the surety. Correct answer is A. Immediately approve the principal's request for additional funds and an extension of time to avoid a default, thereby protecting the obligee from project delays. Explanation: this scenario is professionally challenging because it requires the surety to balance the immediate financial interests of the principal with the long-term obligations and potential liabilities to the obligee. The surety must act with integrity and adhere to the contractual terms of the performance and payment bonds, which are designed to protect the obligee from financial loss. Misinterpreting or disregarding the surety's obligations under these bonds can lead to significant financial repercussions and regulatory scrutiny. The correct approach involves the surety diligently investigating the principal's claim of unforeseen site conditions and assessing its impact on the project's completion and the obligee's exposure. This requires a thorough review of the contract, the bond provisions, and the principal's documentation. The surety must then communicate its findings and proposed course of action to the obligee in a timely and transparent manner, aligning with the principles of good faith and fair dealing inherent in surety agreements. This aligns with the CIC Commercial Casualty Institute exam's emphasis on understanding the surety's role in managing risk and fulfilling contractual obligations under U.S. surety law. The surety's duty is to protect the obligee's interests while also considering the principal's contractual rights and obligations. An incorrect approach would be to immediately deny the principal's claim without adequate investigation. This fails to uphold the surety's duty of good faith and could expose the surety to claims of breach of contract and bad faith by both the principal and the obligee. Another incorrect approach would be to unilaterally agree to a change order that significantly alters the scope or cost of the project without the obligee's explicit consent or a clear understanding of how the performance and payment bonds will be affected. This could jeopardize the surety's collateral position and create unforeseen liabilities. Finally, ignoring the obligee's concerns and proceeding with a solution that does not adequately address the project's completion or the potential for unpaid labor and materials would violate the fundamental purpose of the performance and payment bonds and expose the surety to significant risk. Professionals should approach such situations by first understanding the specific terms and conditions of the performance and payment bonds, as well as the underlying construction contract. They must then conduct a comprehensive and objective investigation, gathering all relevant facts and documentation. Communication with all parties involved, the principal, the obligee, and potentially subcontractors and suppliers, is crucial. The decision-making process should be guided by the surety's contractual obligations, applicable U.S. surety law, and ethical considerations, prioritizing a resolution that protects the obligee while managing the surety's exposure. Question 2. Operational review demonstrates that a commercial client, a high-end event planning company, has requested a comprehensive general liability policy. During the underwriting process, the client's representative strongly asserts that their business exclusively provides planning, decoration, and staffing services for events, and they do not directly sell, serve, or furnish alcoholic beverages. However, the client acknowledges that many of the events they plan involve venues where alcohol is served by a third-party caterer or the venue itself. The underwriter is considering the application of the liquor liability exclusion within the proposed policy. What is the most appropriate course of action for the underwriter? Option A. Decline to apply the liquor liability exclusion, proceeding with underwriting based on the client's direct representation that they do not sell, serve, or furnish alcohol, and assuming the third-party providers are solely responsible. Option B. Apply the liquor liability exclusion because the events planned by the client involve the presence and consumption of alcohol, regardless of who is directly responsible for its provision. Option C. Advise the client that due to the nature of event planning, a liquor liability exclusion is standard and cannot be removed, regardless of their specific business model, and proceed with underwriting with the exclusion in place. Option D. Conduct a thorough investigation into the specific contractual arrangements between the client and the venues/caterers regarding alcohol service, and review the precise wording of the liquor liability exclusion in the policy to determine if the client's activities fall within its scope before making a decision on its applicability. The correct answer is B. Apply the liquor liability exclusion because the events planned by the client involve the presence and consumption of alcohol, regardless of who is directly responsible for its provision. Explanation: this scenario presents a professional challenge due to the inherent conflict between a client's desire to minimize perceived risk and the insurer's obligation to adhere to policy terms and regulatory requirements. The underwriter must navigate this by applying a thorough understanding of the policy's exclusions, specifically those related to liquor liability, while also considering the ethical implications of potentially misrepresenting coverage to a client. The core of the challenge lies in accurately interpreting and applying the liquor liability exclusion in the context of the insured's business operations, ensuring that the policy's limitations are respected without unfairly denying coverage for legitimate claims. The correct approach involves a meticulous review of the insured's business activities against the specific wording of the liquor liability exclusion. This means determining if the insured's operations, as described, fall within the scope of activities typically excluded under such a provision, such as the sale, service, or furnishing of alcoholic beverages. If the review confirms that the insured's business does not engage in these activities, then the exclusion would not apply, and the underwriter should proceed with underwriting based on the other policy terms. This approach is ethically sound and regulatorily compliant because it upholds the integrity of the insurance contract by accurately assessing risk based on the policy's defined terms and exclusions, thereby preventing misrepresentation and ensuring fair treatment of the insured. An incorrect approach would be to automatically apply the liquor liability exclusion simply because the insured operates a business that might be perceived as having some tangential connection to alcohol, such as a catering company that occasionally serves at events where alcohol is present. This fails to consider the specific definition and scope of the exclusion within the policy. Ethically, this is problematic as it could lead to the denial of coverage for a claim that should be covered, potentially causing significant financial hardship to the insured. Regulatorily, it could be viewed as a misapplication of policy terms, leading to disputes and potential regulatory scrutiny. Another incorrect approach would be to disregard the liquor liability exclusion entirely based on the client's assertion that they do not directly sell alcohol. While the client's statement is important, it does not absolve the underwriter from the responsibility of verifying the information and understanding the nuances of the exclusion. The exclusion might encompass more than just direct sales, such as providing alcohol or being responsible for its service. Failing to investigate further and relying solely on the client's word is a failure in due diligence, which is a cornerstone of sound underwriting and regulatory compliance. This could result in the insurer being exposed to risks they did not intend to cover and potentially facing claims that are explicitly excluded. A third incorrect approach would be to attempt to interpret around the exclusion to provide coverage, perhaps by assuming the client's interpretation of their business is correct without independent verification. This is ethically questionable, as it involves knowingly accepting a risk that the policy explicitly excludes, potentially leading to future coverage disputes and financial losses for the insurer. Regulatorily, this could be seen as a form of adverse selection or a failure to adhere to underwriting guidelines, which are designed to ensure the solvency and stability of the insurance market. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the client's business operations through detailed questionnaires and discussions. Second, meticulously review the relevant policy exclusions, paying close attention to definitions and scope. Third, Cross-reference the client's operations with the exclusions wording to determine applicability. Fourth, consult with legal or claims experts if ambiguity exists. Finally, communicate the underwriting decision and the rationale clearly and transparently to the client, ensuring they understand the coverage provided and any limitations. Question 3. Benchmark analysis indicates that a commercial construction project is in its early stages, with the total completed value not yet definitively determined and expected to fluctuate significantly as the project progresses. The insured has indicated a willingness and ability to provide periodic updates on the project's value. Considering these factors and the typical offerings within builders' risk insurance, which policy approach best aligns with ensuring accurate coverage and premium throughout the construction lifecycle, and what is the primary coverage trigger associated with this approach? Option A, an all-risk policy endorsement, with the coverage trigger being the physical damage to the insured property. Option B, a reporting form policy, with the coverage trigger being the periodic reporting of the project's actual or estimated value by the insured. Option C, a completed value form policy, with the coverage trigger being the commencement of construction activities. Option D, a course of construction policy, with the coverage trigger being the final inspection and approval of the completed structure. Correct answer is B, a reporting form policy, with the coverage trigger being the periodic reporting of the project's actual or estimated value by the insured. Explanation. This scenario presents a common challenge in commercial casualty insurance, specifically within the context of builders' risk policies, where the timing and nature of reporting can significantly impact coverage and premium. The professional challenge lies in accurately distinguishing between the operational requirements of a reporting form policy and a completed value policy, and understanding how each interacts with the concept of coverage triggers. Misinterpreting these distinctions can lead to underinsurance, premium disputes, and potential E&O claims. Careful judgment is required to select the policy type that best aligns with the insured's construction project, life cycle, and reporting capabilities. The correct approach involves selecting the reporting form policy, because the scenario explicitly describes a situation where the value of the insured property is fluctuating and unknown at the inception of coverage, with the insured capable of providing periodic updates. This aligns with the fundamental principle of a reporting form policy, which is designed for situations where the value of the insured property changes during the policy period. The coverage trigger in a reporting form policy is typically tied to the reporting of the actual value, and the premium is adjusted accordingly. This approach ensures that the insured is neither overinsured nor underinsured, and that premiums accurately reflect the risk exposure throughout the construction phase. Regulatory frameworks for commercial casualty insurance, such as those overseen by state departments of insurance in the U.S., emphasize the importance of accurate risk assessment and premium calculation, which this approach upholds. An incorrect approach would be to select the completed value form when the project value is fluctuating and unknown. This form is designed for projects where the final completed value is reasonably ascertainable at policy inception, and coverage is based on that estimated value. Using it in a fluctuating value scenario would likely lead to incorrect premium calculations and potential coverage gaps or excesses, violating the regulatory principle of fair premium and adequate coverage. Another incorrect approach would be to assume that the coverage trigger is solely the commencement of construction, regardless of the policy form. While construction commencement is a critical event, the specific trigger for coverage activation and valuation under a builder's risk policy is dictated by the chosen form. For a reporting form, the trigger is often the reporting of value, whereas for a completed value form, it's the estimated final value. Ignoring this distinction leads to a misunderstanding of how coverage is established and maintained. A further incorrect approach would be to focus solely on the all-risk nature of builders' risk insurance, without considering the reporting requirements inherent in certain forms. While builders' risk policies are typically all risk, the specific terms and conditions, including reporting obligations, are crucial for determining the extent and activation of coverage. Failing to account for these specific policy form requirements misrepresents how coverage is actually applied. The professional reasoning process for similar situations should involve 1. Thoroughly understanding the insured's project, including its life cycle, expected value fluctuations, and their ability to provide updated information. 2. carefully reviewing the available builder's risk policy forms and their respective definitions, coverage triggers, and reporting requirements. 3. Matching the insured's project characteristics and reporting capabilities to the most appropriate policy form, ensuring compliance with regulatory mandates for accurate risk assessment and premium. 4. Clearly communicating the chosen policy's terms, conditions, and reporting obligations to the insured to manage expectations and prevent future disputes. Question 4. The assessment process reveals that a mid-sized e-commerce business, Tech Gadget Emporium, has experienced a significant increase in online transactions and has recently expanded its product offerings to include sensitive personal data collection for a new loyalty program. Their current cyber liability insurance policy, purchased 2 years ago, has standard coverage for data breaches and network interruption. The insurance broker is reviewing the policy for renewal and needs to determine the most appropriate course of action to ensure adequate coverage for Tech Gadget Emporium's evolving risk profile. Option A suggests that Tech Gadget Emporium rely on their general commercial liability policy to cover any potential cyber-related incidents, as it may offer some residual protection. Option B. Advise Tech Gadget Emporium to purchase a standalone cyber insurance policy that specifically addresses the risks associated with collecting and storing sensitive personal data, including coverage for regulatory fines and penalties related to data privacy laws, and enhanced business interruption coverage for extended downtime. Option C. Recommend renewing the existing policy with the same coverage limits and terms, as it has served the client adequately in the past and cyber threats are generally covered. Option D. Propose increasing the limits on the existing policy without a detailed review of the policy's specific endorsements or exclusions, assuming higher limits automatically equate to better coverage for new risks. The correct answer is C. Recommend renewing the existing policy with the same coverage limits and terms, as it has served the client adequately in the past, and cyber threats are generally covered. Explanation: this scenario is professionally challenging because it requires the insurance professional to navigate the complexities of cyber liability coverage in the context of a rapidly evolving threat landscape and a specific regulatory environment. The professional must not only understand the technical aspects of cyber risk, but also apply the relevant CIC Commercial Casualty Institute exam framework to assess coverage adequacy and advise the client appropriately. The core challenge lies in accurately interpreting the policy's scope and exclusions against the backdrop of the insured's actual and potential cyber exposures, ensuring that the coverage aligns with the business's risk profile and regulatory obligations. The correct approach involves a thorough review of the insured's existing cybersecurity measures, incident response plan, and the specific terms and conditions of the cyber liability policy. This includes scrutinizing definitions of covered events, data breach notification costs, business interruption due to cyber incidents, and regulatory fines and penalties. The professional must then compare these policy provisions against the identified risks and the client's operational realities. Regulatory justification stems from the duty of care owed to the client, which mandates providing advice that is informed, accurate, and in the client's best interest, adhering to the principles of sound insurance practice as outlined by the CIC Commercial Casualty Institute exam framework. This ensures the client is neither underinsured nor paying for coverage they do not need, while also complying with any applicable state insurance regulations regarding policy interpretation and advice. An incorrect approach would be to rely solely on the policy's stated limits and general coverage description, without delving into the specifics of the insured's cyber posture and the policy's endorsements or exclusions. This failure to conduct a detailed risk assessment and policy analysis could lead to a misrepresentation of coverage, leaving the client exposed to unforeseen losses. Another incorrect approach is to assume that standard cyber insurance policies automatically cover all emerging cyber threats, such as ransomware attacks involving data exfiltration and extortion, without verifying specific policy language and endorsements. This oversight neglects the nuanced nature of cyber risk and the importance of tailored coverage. Furthermore, an approach that prioritizes expediency over accuracy by simply renewing the existing policy without re-evaluating the client's evolving needs and the current threat environment is professionally deficient. This can result in outdated coverage that does not adequately address new or amplified risks. The professional decision-making process for similar situations should involve a systematic approach. First, understand the client's business operations and their specific cyber risks. Second, conduct a comprehensive review of the relevant cyber liability policy, paying close attention to definitions, coverage grants, exclusions, and endorsements. Third, compare the identified risks with the policy's coverage, identifying any gaps or overlaps. Fourth, communicate these findings clearly and concisely to the client, explaining the implications of the coverage and recommending appropriate adjustments. Finally, document all advice and recommendations thoroughly, ensuring compliance with all regulatory requirements and ethical obligations. Question 5. Benchmark analysis indicates that a commercial client operates a catering business that also holds a liquor license for on-site consumption and a permit to sell prepared foods at local farmers markets. When advising on license and permit bonds, which approach best ensures compliance with all applicable regulations? Option A. Rely on the client's assertion that they have always operated without specific bonding for these permits, and therefore, no additional bonds are necessary. Option B. Obtain a single comprehensive surety bond that covers all aspects of the business's operations, assuming a general business license bond will suffice for all permits. Option C. Research the specific bonding requirements for the liquor license and the farmer's market food permits separately, and secure individual surety bonds or endorsements as mandated by each respective regulatory authority. Option D. Secure a general liability insurance policy, as this is typically sufficient to cover any potential regulatory issues related to business operations. The correct answer is B. Obtain a single, comprehensive surety bond that covers all aspects of the business's operations, assuming a general business license bond will suffice for all permits. Explanation: this scenario is professionally challenging because it requires the insurance professional to navigate the nuances of regulatory compliance for license and permit bonds, specifically within the framework of the CIC Commercial Casualty Institute exam's jurisdiction. The core of the challenge lies in accurately identifying which regulatory bodies' requirements are paramount when a business operates in multiple sectors, each potentially governed by different licensing and bonding mandates. Misinterpreting these requirements can lead to significant financial penalties for the insured, reputational damage for the agency, and potential regulatory sanctions. Careful judgment is required to distinguish between general business licensing and specific industry-related permits that necessitate bonding. The correct approach involves a thorough understanding of the specific regulations applicable to each business activity the insured engages in. This means identifying the primary regulatory authority for each license or permit, and then determining if that authority mandates a surety bond as a condition of operation. The justification for this approach is rooted in the fundamental purpose of license and permit bonds, to guarantee compliance with specific laws and regulations. By focusing on the requirements of each individual regulatory body, the professional ensures that the bond adequately protects the public interest and satisfies the legal obligations of the insured for each specific license or permit. This aligns with the principle of acting in the best interest of the client, while adhering strictly to the governing regulatory framework. An incorrect approach would be to assume that a single bond, or a general business license bond, would cover all operational requirements. This fails to recognize that different permits and licenses often have distinct bonding requirements, sometimes with varying penal sums or conditions, dictated by the specific regulatory body overseeing that particular activity. Another incorrect approach would be to rely solely on the insured's self-assessment of their bonding needs without independent verification against the relevant regulations. This bypasses the professional's responsibility to ensure compliance and could leave the insured exposed to regulatory action. A further incorrect approach would be to apply a generic bonding standard without considering the specific nature of the regulated activity, potentially leading to an inadequate bond that does not meet the regulatory mandate. Each of these incorrect approaches represents a failure to adhere to the specific regulatory framework governing license and permit bonds, potentially exposing the insured to non-compliance penalties and the agency to E&O claims. Professional decision-making in similar situations should involve a systematic process of identifying all licenses and permits held by the insured, researching the specific regulatory body for each, and then consulting the applicable statutes and regulations to determine if a surety bond is required, and if so, its specific terms and conditions. This proactive and diligent approach ensures comprehensive coverage and regulatory adherence. Question 6. Governance review demonstrates that a manufacturing facility experienced a fire that caused significant damage to its primary production line. While repairs to the physical structure and replacement of damaged machinery were completed within 90 days, the business experienced a further 60 days of reduced production capacity as it worked to re-establish its supply chain relationships and retrain staff on new equipment. The insurer is evaluating the business income and extra expense claim, which approach best aligns with the principles of business income and extra expense coverage under the CIC Commercial Casualty Institute exam's regulatory framework. Option A. The period of restoration ends 90 days after the fire, as this is when physical repairs were completed, and the business income coverage should cease at this point. Option B. The period of restoration ends when the physical damage is repaired, and extra expense coverage should be limited to costs directly associated with expediting repairs, not for lost income due to operational inefficiencies. Option C. The period of restoration extends for 150 days, encompassing the time for physical repairs and the subsequent period required to resume full production capacity, with business income calculated based on lost net income and continuing expenses. Option D. The period of restoration is limited to 120 days, as this is a standard industry practice for business interruption claims, regardless of the specific circumstances of the loss. The correct answer is A. The period of restoration ends 90 days after the fire, as this is when physical repairs were completed, and the business income coverage should cease at this point. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how business income and extra expense coverages respond to a loss, specifically concerning the definition of a period of restoration and the appropriate valuation methods. The insurer must accurately interpret the policy language and apply it to the unique circumstances of the business interruption, ensuring fair compensation without overpaying or underpaying. This requires careful consideration of the cause of loss, the extent of damage, and the time reasonably required to resume operations, all within the framework of the CIC Commercial Casualty Institute exam's specified regulatory environment. The correct approach involves accurately determining the period of restoration based on the policy's definition and the actual time needed for repairs and resumption of normal business operations, and then applying the appropriate valuation method, which typically involves the business's net income and continuing expenses. This aligns with the regulatory expectation of insurers to act in good faith and to provide coverage as intended by the policy contract. The CIC Commercial Casualty Institute exam emphasizes adherence to policy terms and conditions, and a correct application of these principles ensures the insured is made whole for their actual loss of income and incurred extra expenses during the restoration period. An incorrect approach that focuses solely on the date the physical damage was repaired, without considering the time needed to resume full operations, fails to acknowledge the full scope of the period of restoration, as defined in most commercial property policies. This overlooks the insured's continued loss of income during the ramp-up period. Another incorrect approach that uses a fixed indemnity period, irrespective of the actual loss duration or the policy's specified period of restoration, disregards the policy's intent to cover actual losses. Furthermore, an approach that fails to account for continuing expenses when calculating business income loss would undercompensate the insured. These approaches violate the principle of indemnification and could be seen as a failure to act in good faith, potentially leading to regulatory scrutiny. Professionals should approach such situations by thoroughly reviewing the policy's business income and extra expense provisions, paying close attention to definitions of period of restoration and any limitations. They should then gather all relevant documentation regarding the loss, including repair timelines, operational resumption efforts, and financial records. A systematic analysis of the cause of loss, the extent of damage, and the reasonable time to return to normal operations is crucial. When in doubt, consulting with underwriting or legal counsel within the insurer's organization is a prudent step to ensure compliance with policy terms and regulatory requirements. Question 7. The performance metrics show a significant increase in the number of claims involving requests for reimbursement of defense costs, bail bond premiums, and lost wages. A commercial insured, a small manufacturing business, is facing a lawsuit alleging product liability. The insured has incurred substantial legal fees to defend against the lawsuit, has posted a bail bond for a key employee who was arrested in connection with the alleged product defect, and the business owner has been unable to conduct sales meetings due to the time spent managing the legal defense. The insurer is reviewing these supplementary payment requests. Which of the following approaches best aligns with the regulatory framework and policy provisions for supplementary payments under a commercial general liability policy? Option A. Pay all reasonable and documented defense costs incurred by the insured, reimburse the premium paid for the bail bond, and compensate the insured for documented lost wages directly attributable to the time spent on the legal defense, subject to policy limits and conditions. Option B. Deny reimbursement for defense costs as the claim has not yet gone to trial, refuse to pay for the bail bond premium as it is not directly related to the damages sought in the lawsuit, and deny lost wages as the business owner's inability to conduct sales is a business interruption issue, not a covered loss. Option C. Pay defense costs only if the insured is found not liable, refuse to pay for the bail bond premium as it is not a direct cost of the lawsuit, and deny all claims for lost wages as they are speculative and difficult to quantify. Option D. Pay defense costs only up to a predetermined internal guideline, refuse to pay for the bail bond premium citing it as a personal expense of the employee, and offer a nominal amount for lost wages without requiring detailed documentation. The correct answer is A. Pay all reasonable and documented defense costs incurred by the insured, reimburse the premium paid for the bail bond, and compensate the insured for documented lost wages directly attributable to the time spent on the legal defense, subject to policy limits and conditions. Explanation. This scenario presents a common challenge in commercial casualty claims handling, interpreting the scope and limits of supplementary payments, specifically defense costs, bail bonds, and loss of earnings, as defined by the policy and relevant regulations. The professional challenge lies in accurately applying policy language and regulatory guidance to a specific claim situation, ensuring fair and timely payment while avoiding overpayment or underpayment, which can lead to coverage disputes, regulatory scrutiny, and reputational damage. Careful judgment is required to distinguish between covered and uncovered expenses, especially when policy language might be ambiguous or when claimant requests extend beyond standard interpretations. The correct approach involves a thorough review of the commercial general liability policies, ensuring agreement and conditions related to supplementary payments. This includes understanding the policy's definition of defense costs and any sublimits or exclusions that might apply. It also requires verifying the necessity and reasonableness of bail bond expenses, ensuring they are directly related to the insured's appearance in court for a covered offense. Furthermore, assessing loss of earnings requires careful documentation and a clear link to the insured's inability to work due to the covered claim. Adherence to the CIC Commercial Casualty Institute exams regulatory framework, which emphasizes fair claims practices and policyholder protection, mandates that the insurer pay for all expenses that are legally and contractually obligated under the policy. This includes defense costs incurred by the insured, reasonable bail bond premiums, and documented loss of earnings directly resulting from the insured event, up to any policy limits. An incorrect approach would be to deny coverage for defense costs solely because the insured eventually settled the claim without a trial. This fails to recognize that defense costs are often incurred regardless of the final outcome and are a fundamental part of the insurer's obligation to defend. Another incorrect approach is to refuse to pay for bail bond premiums, arguing they are not directly related to the damages sought in the underlying lawsuit. Bail bonds are a necessary expense to ensure the insured's presence in court, which is a condition for the legal process to proceed, and are often considered a covered supplementary payment. Finally, an incorrect approach would be to automatically deny all loss of earnings claims without reviewing supporting documentation, such as employer verification or medical records, which are essential for substantiating the claim and demonstrating the direct impact of the covered event on the insured's ability to earn income. Such denials would violate fair claims handling practices and potentially breach the insurance contract. Professional decision-making in similar situations requires a systematic process. First, thoroughly understand the policy language and all endorsements. Second, Gather all relevant claim documentation from the insured and any third parties. Third, consult applicable state insurance regulations and case law regarding supplementary payments and fair claims practices. Fourth, make a determination based on the policy and regulation, communicating the decision clearly and promptly to the insured. If there is ambiguity, err on the side of providing coverage where reasonably supported by the policy and regulations, while still managing costs prudently. Question 8. The evaluation methodology shows that when reviewing a commercial general liability policy for a nonprofit organization that utilizes both paid staff and a significant number of unpaid volunteers for its community outreach programs, determining the scope of the insured status for these different groups is paramount for accurate risk assessment. Which of the following best describes the process for ensuring appropriate coverage for all relevant parties? Option A. Rely on the common understanding of employee to include all individuals working for the organization and assume volunteers are covered under this broad interpretation. Option B. Assume that all individuals performing services for the nonprofit, whether paid or unpaid, are automatically considered insureds under the policy due to the nature of their contribution. Option C. Focus solely on the named insured and assume that any liability arising from the actions of volunteers will be handled separately by the volunteers themselves. Option D. Review the policy's declarations page and definitions section to ascertain if volunteers are explicitly included as insureds, and if not, consider appropriate endorsements to extend coverage. The correct answer is D. Review the policy's declarations page and definitions section to ascertain if volunteers are explicitly included as insureds, and if not, consider appropriate endorsements to extend coverage. Explanation. The evaluation methodology shows that accurately identifying who qualifies as an insured under a commercial casualty policy is a foundational element of proper risk management and claims handling. This scenario is professionally challenging because the lines between named insureds, employees, and volunteers can become blurred, especially in organizations with complex structures or those relying heavily on volunteer support. Misinterpreting these relationships can lead to significant coverage gaps, denied claims, and potential E&O exposure for the agent or broker. Careful judgment is required to apply the policy's definitions and endorsements precisely to the facts of the insured's operations. The correct approach involves a meticulous review of the policy's declarations page, definitions section, and any relevant endorsements to determine who is explicitly named as an insured and how other individuals or entities are brought under the coverage. This requires understanding that the named insured is the primary party to the contract, while employees are typically covered as insureds by virtue of their employment relationship, as defined by the policy. Volunteers, however, may or may not be automatically included and often require specific policy language or endorsements to be considered insureds. This approach is correct because it adheres strictly to the contractual language of the insurance policy, which is the governing document. It aligns with regulatory expectations that insurance contracts are interpreted according to their plain meaning, and that agents and brokers have a duty to ensure coverage accurately reflects the insured's operations and exposures. An incorrect approach would be to assume that all individuals performing work for the named insured are automatically insureds. This fails to recognize that policy definitions are specific and that coverage for volunteers in particular is not a given. This approach risks leaving individuals exposed to liability that the policy was intended to cover, leading to potential claims disputes and regulatory scrutiny for misrepresentation or inadequate advice. Another incorrect approach would be to rely solely on the common understanding of employee without consulting the policy's definition. Policies often have specific definitions that may include or exclude certain types of workers, such as leased employees or independent contractors, who might otherwise be considered employees in a general sense. This approach is flawed because it substitutes a general understanding for the precise contractual terms, potentially leading to coverage denials and regulatory noncompliance. A third incorrect approach would be to assume that any individual acting on behalf of the organization, regardless of their formal relationship, is an insured. This overlooks the critical distinction between those who are contractually covered and those who are not. This approach is problematic as it can lead to the erroneous assumption of coverage for individuals who are not contemplated by the policy, creating a false sense of security and exposing the insured organization to uninsured liabilities. The professional decision-making process for similar situations should involve a systematic review of the policy contract, a thorough understanding of the insured's organizational structure and operational activities, and a clear application of the policy's definitions and endorsements to those facts. When in doubt, consulting with the underwriter or seeking clarification from the insurer is a prudent step to ensure accurate coverage placement and to avoid future disputes. Question 9. The evaluation methodology shows that the calculation of an experience modification factor, EMOD, for a commercial casualty policy is a critical component of premium determination. When comparing two different approaches to calculating this factor, one approach meticulously applies the NCCI basic manual rules, considering the full 3-year experience period, the designated expected loss rates, and the appropriate primary and excess loss values for the relevant state. The other approach, however, prioritizes only the most recent policy year's claims data and makes subjective adjustments based on the insured's perceived current safety initiatives. Which of these methodologies is the correct and professionally sound approach for calculating an experience modification factor, and why is the alternative approach flawed? Option A. The approach that prioritizes the most recent policy year's claims data is correct because it reflects the most current risk profile of the insured, while the approach that meticulously applies NCCI rules is flawed because it is overly rigid and does not account for recent improvements in safety. Option B. The approach that makes subjective adjustments based on safety initiatives is correct because it incentivizes proactive risk management, while the approach that meticulously applies NCCI rules is flawed because it is too formulaic and does not recognize individual business efforts. Option C. Both approaches are equally valid as long as the insurer and insured agree on the methodology, as the primary goal is to arrive at a mutually acceptable premium. Option D. The approach that meticulously applies the NCCI basic manual rules is correct because it adheres to the established regulatory framework for objective risk assessment over a defined historical period, while the alternative approach is flawed due to its reliance on subjective judgment and incomplete data, violating regulatory mandates for fairness and accuracy. The correct answer is D. The approach that meticulously applies the NCCI basic manual rules is correct because it adheres to the established regulatory framework for objective risk assessment over a defined historical period, while the alternative approach is flawed due to its reliance on subjective judgment and incomplete data, violating regulatory mandates for fairness and accuracy. Explanation. The evaluation methodology for experience rating, specifically the calculation of the experience modification factor, EMOD, presents a professionally challenging scenario due to the inherent complexity and the significant financial implications for both insurers and policyholders. Misinterpreting or misapplying the rules can lead to substantial overpayments or underpayments of premiums, impacting the insurer's profitability and the insured's cost of doing business. Careful judgment is required to ensure the EMOD accurately reflects the insured's past loss experience relative to the expected experience for their industry classification, adhering strictly to the governing manual rules. The correct approach involves a thorough understanding and application of the NCCI, National Council on Compensation Insurance, basic manual rules for experience rating, as this is the standard framework for most U.S. states. This approach correctly identifies that the EMOD is a ratio comparing an insured's actual losses to their expected losses, adjusted by specific parameters like the expected loss rate, the primary and excess loss values, and the state's rating values. The regulatory justification lies in the NCCI role as a statistical agent and data service organization, which develops and maintains these rating plans to ensure fairness and consistency in workers' compensation insurance pricing. Adherence to these rules is mandated by state insurance departments, ensuring that the EMOD is calculated objectively and without bias, thereby promoting equitable premium costs. An incorrect approach would be to solely focus on the most recent policy year's losses without considering the full 3-year experience period mandated by the NCCI. This failure ignores the fundamental principle of experience rating, which is to provide a stable and predictive measure of risk over a defined historical period. This approach is ethically problematic as it can unfairly penalize or reward an insured based on a single, potentially anomalous, year of claims. Another incorrect approach would be to arbitrarily adjust the EMOD based on subjective assessments of the insured's current safety efforts or perceived future risk, without any basis in the established NCCI formulas. This violates the regulatory requirement for objective calculation and introduces bias into the rating process. Such an approach undermines the integrity of the experience rating system and can lead to disputes and regulatory scrutiny. A further incorrect approach would be to apply different weighting factors to primary and excess losses than those specified in the NCCI manual, without proper authorization or justification. The manual clearly defines how losses are split between primary and excess classifications, and deviating from this, without adhering to the established procedures for exceptions or endorsements, is a direct violation of regulatory guidelines. This can distort the EMOD, making it an inaccurate reflection of the insured's risk profile. The professional decision-making process for similar situations requires a commitment to continuous learning and a deep understanding of the NCCI basic manual rules. Professionals must prioritize accuracy and adherence to established procedures over expediency or subjective judgment. When faced with complex scenarios or potential ambiguities, consulting the official NCCI manuals, seeking clarification from underwriting or actuarial departments, and staying updated on any rule changes or interpretations are crucial steps. This ensures that the EMOD is calculated correctly, fostering trust and transparency in the workers' compensation insurance market. Question 10. What factors determine the eligibility and specific coverage limitations for flood insurance under the National Flood Insurance Program, NFIP, for a commercial property located in a designated flood hazard area? Option A. The presence of any water-related peril, regardless of its cause or the property's official flood zone status. Option B. The official flood zone designation assigned by FEMA. The NFIP policy's definitions of covered structures and contents, and specific exclusions for basements and detached structures. Option C. The general understanding that any water damage to the property constitutes a covered flood event under the NFIP. Option D. The commercial property owner's historical experience with water damage and their personal assessment of the flood risk. Correct answer is B. The official flood zone designation assigned by FEMA, the NFIP policy's definitions of covered structures and contents, and specific exclusions for basements and detached structures. Explanation. This scenario is professionally challenging because accurately determining flood insurance eligibility and coverage under the National Flood Insurance Program, NFIP, requires a precise understanding of regulatory definitions and limitations, especially concerning the definition of a flood and the types of structures or contents that are covered. Misinterpreting these can lead to significant financial losses for policyholders and potential E&O claims for the agent. Careful judgment is required to navigate the complexities of flood zone designations and the specific exclusions within NFIP policies. The correct approach involves a thorough review of the property's flood zone designation as determined by FEMA and an understanding of the specific definitions of building and contents as outlined in the NFIP policy documents. This approach is right because the NFIP eligibility and coverage are strictly defined by federal regulations. FEMA flood maps are the definitive source for flood zone determination, and the policy's terms and conditions dictate what constitutes a covered loss. Adhering to these regulatory definitions ensures that the policy is correctly placed and that the insured understands the scope of their coverage, preventing misunderstandings and potential disputes. An incorrect approach that relies solely on the property owner's perception of flood risk fails because the NFIP is a federal program with objective criteria for eligibility and coverage. The owner's opinion, while important for their risk assessment, does not override FEMA official flood zone designations or the policy's specific exclusions. This approach is ethically and regulatorily flawed as it misrepresents the program's requirements and could lead to the purchase of an inappropriate or inadequate policy. Another incorrect approach that assumes all water damage is covered under flood insurance is also professionally unacceptable. The NFIP specifically defines what constitutes a flood, e.g., inundation of normally dry land by water. Damage from other water-related perils, such as sewer backup or surface water runoff not caused by a general inundation, may not be covered under a standard NFIP policy and would require separate endorsements or policies. This failure to adhere to the specific definition of flood is a direct regulatory violation and an ethical lapse in providing accurate coverage advice. Finally, an approach that overlooks the coverage limitations for detached structures and basements is also incorrect. The NFIP has specific rules regarding coverage for these areas. Detached structures are often excluded or have limited coverage, and basement contents are typically not covered unless specific endorsements are purchased. Failing to identify and communicate these limitations is a regulatory failure and a breach of professional duty to inform the client of all policy terms. Professionals should approach such situations by first confirming the property's official flood zone designation through FEMA resources. They must then meticulously review the NFIP policy's definitions of building, contents, and flood, paying close attention to exclusions and limitations for basements and detached structures. Educating the client on these specific aspects of the policy, in writing, is crucial for managing expectations and ensuring compliance with regulatory requirements. Question 11. Examination of the data shows that a commercial property insurance policy is in place for a small retail business. The insured reports significant damage to their premises due to a fire. Among the damaged items are store fixtures, inventory, a customer's laptop that was left for repair, and the insured's personal tools used for minor maintenance. The insured believes all these items should be covered under their business personal property coverage. What is the most appropriate course of action for the insurance professional to take in assessing coverage? Option A. Advise the insured that all damaged items, including the customer's laptop and personal tools, are likely covered under the business personal property provision as they were on the premises during the loss and related to the business operation. Option B. Recommend that the insured file a claim for all damaged items and let the claims department determine coverage based on the overall loss. Option C. Conduct a detailed review of the policy's definitions for covered property, specifically buildings, business personal property, and personal property of others, and then compare each damaged item against these definitions to determine accurate coverage. Option D. Inform the insured that only the inventory and store fixtures are covered, as the customer's laptop and personal tools are explicitly excluded from business personal property coverage. The correct answer is A. Advise the insured that all damaged items, including the customer's laptop and personal tools, are likely covered under the business personal property provision as they were on the premises during the loss and related to the business operation. Explanation. This scenario presents a professional challenge because it requires the insurance professional to navigate a situation where a client's understanding of their coverage may be incomplete, potentially leading to a claim denial and significant financial hardship for the client. The core of the challenge lies in accurately interpreting the policy's terms regarding covered property, specifically distinguishing between the building, business personal property, and personal property of others, and then communicating this clearly and ethically to the client. Careful judgment is required to ensure the client receives accurate information and appropriate guidance, even if it means delivering news that is not favorable. The correct approach involves a thorough review of the policy documents, specifically the definitions and insuring agreements related to covered property. This includes understanding how the policy defines buildings, business personal property, and personal property of others. Based on this review, the professional must then accurately determine which of the damaged items fall under each category according to the policy's language. The ethical and regulatory justification for this approach is rooted in the duty of utmost good faith owed to the insured. This duty requires the insurer and its representatives to act honestly and fairly, providing clear and accurate information about coverage. Misrepresenting or misinterpreting policy terms, even unintentionally, can lead to claims of bad faith and regulatory sanctions. The professional must adhere strictly to the policy's wording and the governing regulations of the CIC Commercial Casualty Institute exam jurisdiction, which mandate transparency and accurate representation of policy benefits and limitations. An incorrect approach would be to assume coverage for all damaged items based on the client's general description of their business operations. This fails to adhere to the specific definitions within the policy and could lead to an incorrect coverage determination. The regulatory failure here is a breach of the duty to accurately interpret and apply policy terms, potentially leading to an improper claim payment or denial. Another incorrect approach would be to provide a definitive coverage opinion to the client without a detailed review of the policy and the specific items damaged. This bypasses the necessary due diligence and could result in providing misleading information, violating the principle of utmost good faith and potentially exposing the insurer to liability. A third incorrect approach would be to advise the client to simply list all damaged items as business personal property, without verifying if they meet the policy's definition, particularly if some items are clearly personal property of others or fixtures that might be considered part of the building. This constitutes a misrepresentation of coverage and a failure to act in the client's best interest by not guiding them toward accurate reporting. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the client's reported loss and the items involved. Second, meticulously review the relevant sections of the insurance policy, paying close attention to definitions and ensuring agreements for covered property. Third, compare the damaged items against these policy definitions to categorize them accurately. Fourth, communicate the findings to the client clearly and empathetically, explaining the policy's provisions and how they apply to their specific situation, even if it means explaining limitations in coverage. Finally, document all communications and decisions thoroughly. Question 12. When evaluating a commercial package policy, CPP, for a client's manufacturing business, an agent discovers that the common policy declarations list the named insured as XYZ Manufacturing Inc. and its wholly owned subsidiary, ABC Components LLC. The common policy conditions state that notice of cancellation will be sent to the first named insured. The insured's primary contact, however, only ever refers to XYZ Manufacturing Inc. When discussing the business operations and insurance needs, which of the following approaches best ensures the agent is accurately advising the client regarding the policy's scope and conditions? Option A. Advise the client that coverage extends to both XYZ Manufacturing Inc. and ABC Components LLC, and that any cancellation notices will be sent to the primary contact at XYZ Manufacturing Inc., as this is the first named insured. Option B. Advise the client that the common policy declarations and conditions are standard and likely do not require detailed review for this particular policy, focusing instead on the specific coverages for manufacturing operations. Option C. Advise the client that coverage is for XYZ Manufacturing Inc. and ABC Components LLC, but that cancellation notices will be sent to the primary contact's personal email address, as this is how they prefer to receive communications. Option D. Advise the client that coverage is primarily for XYZ Manufacturing Inc., and that ABC Components LLC may have separate coverage, as the primary contact has not mentioned the subsidiary. The correct answer is A. Advise the client that coverage extends to both XYZ Manufacturing Inc. and ABC Components LLC, and that any cancellation notices will be sent to the primary contact at XYZ Manufacturing Inc., as this is the first named insured. Explanation: this scenario is professionally challenging because it requires the agent to reconcile potentially conflicting information presented in different sections of a commercial package policy, CPP. The common policy declarations and common policy conditions are foundational documents that define the scope and terms of the coverage. Misinterpreting or overlooking details within these sections can lead to significant errors in coverage advice, potentially exposing the insured to uninsured losses or leading to the issuance of a policy that does not meet their needs. Careful judgment is required to ensure all relevant declarations and conditions are understood and applied correctly. The correct approach involves meticulously reviewing the common policy declarations to identify all listed insureds, the named insured, the policy period, and the specific coverages and limits applicable to each location and business operation. This must then be cross-referenced with the common policy conditions, which outline general provisions such as cancellation, premium payment, and inspection rights. The agent must ensure that the understanding of the insured's operations and risk exposures aligns precisely with what is declared and conditioned in the policy documents. This approach is correct because it adheres to the fundamental principle of accurate policy interpretation, which is a core ethical and regulatory obligation for insurance agents. By focusing on the explicit declarations and conditions, the agent ensures they are providing advice based on the actual terms of the contract, thereby fulfilling their duty of care and complying with regulations that mandate accurate representation of policy terms. An incorrect approach that focuses solely on the insured's verbal description of their business without verifying it against the common policy declarations is professionally unacceptable. This fails to acknowledge the legal primacy of the written policy contract. The declarations page is the definitive statement of what is insured, and relying solely on oral representations can lead to a misunderstanding of coverage scope, limits, or exclusions, violating regulatory requirements for accurate advice and potentially leading to E&O claims. Another incorrect approach that prioritizes the coverage provided by individual coverage parts over the overarching common policy declarations and conditions is also flawed. While understanding individual coverage parts is crucial, the common policy declarations and conditions set the framework for the entire CPP. Ignoring these foundational elements can lead to misinterpretations of how the policy as a whole functions, such as how cancellation notices are handled or how premium audits are conducted, which are governed by the common policy conditions. This oversight can result in noncompliance with policy terms and regulatory expectations for comprehensive policy understanding. A third incorrect approach that assumes all standard commercial casualty policies contain identical declarations and conditions, and therefore skips a detailed review, is highly problematic. While there are standard forms, the common policy declarations are specific to each insured and policy, detailing unique named insureds, policy periods, locations, and limits. The common policy conditions, while generally uniform, can have endorsements that modify their application. This assumption bypasses the due diligence required to ensure the policy accurately reflects the insured's current risk profile and contractual agreements, violating the agent's responsibility to provide tailored and accurate advice. The professional decision-making process for similar situations should involve a systematic review of all policy documents, starting with the common policy declarations and common policy conditions, before delving into individual coverage parts. This ensures a foundational understanding of the policy structure, terms, and conditions. Agents should always verify the insured's understanding of the policy against the written contract and be prepared to explain how the declarations and conditions impact their coverage. This methodical approach, grounded in the specific terms of the policy, is essential for ethical practice and regulatory compliance. Question 13. Stakeholder feedback indicates that a mid-sized retail company has discovered that a long-term accounting clerk, who had access to the company's online banking portal, has been systematically transferring small amounts of company funds into a personal offshore account over the past 2 years. The clerk did not alter any invoices, checks, or financial statements, nor did they forge any signatures. The company is seeking to file a claim under its commercial crime insurance policy. Based on the provided information and the typical structure of commercial crime policies, which of the following approaches best addresses the claim? Option A. The claim should be denied because there is no evidence of physical theft of company assets or the falsification of physical documents. Option B. The claim should be evaluated under the theft insuring agreement, as the clerk has unlawfully taken company funds for personal use. Option C. The claim should be evaluated under the employee dishonesty insuring agreement, as the clerk's actions constitute fraudulent and dishonest acts resulting in financial loss to the company, without involving the alteration or forgery of documents. Option D. The claim should be evaluated under the forgery or alteration insuring agreement, as the unauthorized transfer of funds represents a fraudulent manipulation of financial records. The correct answer is C. The claim should be evaluated under the employee dishonesty insuring agreement, as the clerk's actions constitute fraudulent and dishonest acts resulting in financial loss to the company, without involving the alteration or forgery of documents. Explanation. This scenario presents a professional challenge because it requires the insurance professional to distinguish between different types of employee dishonesty and their coverage under a commercial crime policy, specifically focusing on the nuances of employee dishonesty versus forgery or alteration. The difficulty lies in accurately categorizing the employee's actions based on the policy's definitions and exclusions, which directly impacts the claim's validity and the insured's protection. Careful judgment is required to avoid misinterpreting the policy language or applying it incorrectly to the facts. The correct approach involves recognizing that the employee's actions, while dishonest, primarily involved unauthorized transfers of funds for personal gain, without altering or forging any documents to facilitate these transfers. This aligns with the definition of employee dishonesty, which typically covers loss due to fraudulent or dishonest acts committed by an employee. The policy's coverage for employee dishonesty would likely apply here, assuming the employee meets the policy's definition of an employee, and the loss is within the policy limits and not subject to specific exclusions. This approach is professionally sound because it adheres to the principle of indemnification, ensuring the insured is compensated for covered losses as intended by the policy contract, and it correctly interprets the policy's insuring agreements based on the factual circumstances. An incorrect approach would be to immediately classify the loss under forgery or alteration. This is incorrect because the employee did not alter any existing documents or forge new ones to perpetrate the fraud. The unauthorized transfers were likely executed through legitimate, albeit unauthorized, system access, or by initiating transactions that did not require document alteration. Applying the forgery or alteration coverage would be a misinterpretation of the policy language, as this coverage typically applies to losses resulting from the actual falsification or fraudulent creation of documents. This failure to accurately categorize the loss leads to an incorrect coverage determination and potentially denies a valid claim. Another incorrect approach would be to deny the claim outright, citing a lack of specific evidence of physical theft of assets. This is incorrect because employee dishonesty coverage is designed to protect against financial losses resulting from fraudulent acts, not just the physical pilfering of tangible property. The unauthorized transfer of funds constitutes a financial loss directly attributable to the employee's dishonest actions. Denying the claim on this basis demonstrates a misunderstanding of the scope of crime insurance and the nature of financial fraud. A third incorrect approach would be to assume that any unauthorized financial transaction automatically falls under a broad interpretation of theft, without considering the specific definitions within the crime policy. While unauthorized fund transfers are a form of theft, crime policies often have specific insuring agreements for employee dishonesty, forgery or alteration, and theft, each with distinct triggers and definitions. Relying on a generic understanding of theft without consulting the policy's precise language for employee dishonesty would lead to an inaccurate assessment of coverage. A professional decision-making process for similar situations should involve a thorough review of the commercial crime policy, paying close attention to the definitions of employee, dishonesty, forgery or alteration, and theft. The facts of the claim must be meticulously analyzed to determine which insuring agreement, if any, is triggered. This involves understanding the specific actions taken by the employee and how they align with the policy's language. If ambiguity exists, consulting policy endorsements, or seeking clarification from the underwriter or legal counsel is a prudent step. The ultimate goal is to apply the policy's terms and conditions fairly and accurately to the reported loss. Question 14. The monitoring system demonstrates that a severe storm has caused significant damage to a farmer's primary barn, which houses a valuable herd of dairy cows. The storm also resulted in several cows escaping the damaged barn and causing a traffic accident on a nearby road. Considering the CIC Commercial Casualty Institute examines regulatory framework for farm insurance, which approach best addresses the insurance implications of this incident? Option A. Advise the farmer that the storm damage to the barn is covered under property insurance, but any issues related to the livestock, including their escape and subsequent accident, are excluded under standard farm policies and require a separate specialized policy. Option B. Assess coverage solely under the farm property section for the physical damage to the barn, and separately evaluate any potential liability claims arising from the escaped livestock. Option C. Review the farm property coverage for the barn damage, the specific livestock coverage for the cow's injuries or deaths, and the farm liability coverage for damages and injuries caused by the escaped livestock, considering any relevant endorsements. Option D. Initiate a claim under the farm liability section for the damage to the barn and the escaped livestock, as all incidents stemming from the storm are considered a single liability event. Correct answer is B. Assess coverage solely under the farm property section for the physical damage to the barn, and separately evaluate any potential liability claims arising from the escaped livestock. Explanation. This scenario presents a professional challenge because it requires an insurance professional to accurately assess and apply coverage principles to a complex farm operation, specifically concerning the interplay between property, liability, and livestock coverage. The challenge lies in discerning the precise scope of coverage for a unique farm risk that could fall under multiple policy sections or require specialized endorsements, Demanding a thorough understanding of the CIC Commercial Casualty Institute exam's regulatory framework for farm insurance. Careful judgment is required to avoid underinsuring the farm or misinterpreting policy language, which could lead to significant financial loss for the insured and potential E&O claims for the agent. The correct approach involves a comprehensive review of the farm's operations, identifying all potential risks to property, liability, and livestock, and then meticulously matching these risks to the specific provisions and endorsements within the farm insurance policy. This includes understanding how coverage for a damaged barn housing livestock might be triggered under property coverage, while the injury or death of the livestock itself might fall under a separate livestock coverage section. Furthermore, any potential liability arising from the livestock's actions, such as escaping and causing an accident, must be addressed by the farm liability section. This approach is correct because it adheres to the principle of accurate risk assessment and policy application, ensuring the insured has appropriate protection as defined by the policy and relevant regulations governing farm insurance. It prioritizes the insured's needs by ensuring all potential exposures are considered and covered according to the policy's terms and conditions, aligning with ethical obligations to provide competent advice. An incorrect approach that focuses solely on the physical damage to the barn, without considering the livestock, within it fails to recognize the interconnectedness of farm risks. This approach is ethically and regulatorily flawed because it neglects a significant component of the insured's potential loss, potentially leaving the livestock uninsured or inadequately covered, which is a direct violation of the duty to provide adequate coverage. Another incorrect approach that assumes all livestock-related incidents are covered under a general farm liability policy overlooks the specific nature of livestock coverage, which often has its own distinct terms, conditions, and limits. This is a regulatory failure as it misrepresents the scope of coverage and can lead to claim denials. A third incorrect approach that relies on a generic understanding of farm insurance without consulting the specific policies, endorsements, or exclusions for unique farm operations, also problematic. This is a professional and ethical failure, as it demonstrates a lack of due diligence and a failure to apply specialized knowledge required for farm insurance, potentially leading to coverage gaps and unmet client expectations. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's specific farm operations and identify all potential exposures. Second, meticulously review the applicable insurance policy, including all endorsements and exclusions, to determine how these exposures are addressed. Third, consult relevant regulatory guidance and industry best practices for farm insurance. Fourth, clearly communicate the coverage provided, any limitations, and potential gaps to the client, recommending appropriate endorsements or additional coverage where necessary. This systematic process ensures that advice is accurate, compliant, and in the best interest of the insured. Question 15. Regulatory review indicates that a vessel has sustained damage during a storm, resulting in damage to the vessel itself, loss of some of the cargo on board, and a minor oil spill that required containment efforts. The insurance broker is reviewing the claims. Which of the following approaches best demonstrates adherence to regulatory requirements for advising on and managing commercial casualty claims in ocean marine insurance? Option A. The broker meticulously reviews the hull insurance policy to determine coverage for the vessel damage, the cargo insurance policy for the lost goods, and the protection and indemnity (P&I) policy for the costs associated with the oil spill containment and any third-party liabilities arising from the spill. Option B. The broker assumes that the hull insurance policy will cover all damages, including the lost cargo and the costs of the oil spill, as it is the primary policy for the vessel. Option C. The broker focuses solely on the damage to the vessel under the hull policy and informs the insured that any cargo loss or environmental cleanup costs are not covered by their marine insurance. Option D. The broker advises the insured that the cargo insurance policy is the only relevant policy to review, as the primary loss originated from the cargo being damaged. Correct answer is A. The broker meticulously reviews the hull insurance policy to determine coverage for the vessel damage, the cargo insurance policy for the lost goods, and the protection and indemnity (P&I) policy for the costs associated with the oil spill containment and any third-party liabilities arising from the spill. Explanation. This scenario presents a professional challenge due to the inherent complexities and specialized nature of ocean marine insurance, particularly concerning the interplay between hull, cargo, and liability coverages. A broker must possess a nuanced understanding of how these distinct but interconnected policies respond to a single casualty event. The challenge lies in accurately identifying the scope of coverage under each policy and ensuring that the insured's overall protection is comprehensive and compliant with regulatory expectations for advice and placement. Careful judgment is required to avoid gaps or overlaps in coverage that could lead to financial loss for the insured or regulatory scrutiny for the broker. The correct approach involves a thorough examination of the casualty report and the specific policy wordings for hull, cargo, and protection and indemnity, P&I, insurance. This approach is right because it directly addresses the regulatory expectation that insurance professionals provide advice and place coverage that accurately reflects the insured's needs and the risks involved. Specifically, understanding that hull insurance covers damage to the vessel itself, cargo insurance covers the goods being transported, and P&I insurance covers third-party liabilities, such as injury to crew, damage to other vessels or property, and pollution is fundamental. By meticulously reviewing the policy terms and conditions in light of the casualty, the broker can determine which policy or policies are triggered and to what extent, ensuring that the insured is not left uninsured for a covered peril. This aligns with the CIC Commercial Casualty Institute. Exams focus on practical application of commercial casualty insurance principles within a regulatory framework that emphasizes competence and client best interests. An incorrect approach would be to assume that a single policy, such as hull insurance, automatically covers all aspects of the casualty. This fails to recognize the distinct nature of cargo and P&I coverages, which are designed to address different types of losses. The regulatory failure here is a lack of due diligence and a failure to understand the scope of different marine insurance policies, potentially leading to underinsurance for the client. Another incorrect approach would be to focus solely on the physical damage to the vessel hull and overlook potential third-party liabilities that may arise from the casualty, such as pollution or damage to port facilities. This demonstrates a failure to appreciate the comprehensive risk management aspect of marine insurance and the critical role of P&I coverage. The regulatory and ethical failure is a misrepresentation of the insured's potential exposures and a failure to recommend appropriate coverage, violating the duty of care. A third incorrect approach would be to advise the insured that their cargo insurance will cover the damage to the vessel itself. This fundamentally misunderstands the purpose of cargo insurance, which is to protect the value of the goods, not the carrying vessel. The regulatory and ethical failure is providing demonstrably incorrect advice regarding policy coverage, which could have severe financial consequences for the insured and expose the broker to significant liability. The professional reasoning process for similar situations should involve a systematic review of the insured's operations, specific risks they face, and the available insurance products. This includes 1. Understanding the client's business and potential exposures. 2. Thoroughly reviewing the terms, conditions, exclusions, and endorsements of all relevant insurance policies. 3. Consulting with subject matter experts or underwriters when dealing with complex or unusual risks. 4. Providing clear, accurate, and comprehensive advice to the client, ensuring they understand their coverage. 5. Documenting all advice and decisions made. Question 16. Compliance review shows that a business has engaged a worker who performs services integral to the business's operations. The worker has provided a written statement asserting they are an independent contractor. The underwriter must determine the appropriate classification for workers' compensation coverage. Which of the following approaches best aligns with the regulatory framework for ensuring accurate coverage and compliance? Option A. Accept the worker's written statement of independent contractor status without further inquiry, as this declaration is sufficient to define the employment relationship for insurance purposes. Option B. Defer the classification decision until the worker sustains an injury, at which point the appropriate benefits and coverage can be determined based on the circumstances of the incident. Option C. Conduct a detailed factual investigation into the nature of the worker's relationship with the business, focusing on factors such as the degree of control exercised, the worker's opportunity for profit or loss, and their investment in the work, to determine if they meet the criteria for an employee under the applicable laws. Option D. Classify the worker as an employee and secure workers' compensation coverage immediately, assuming employee status based on the worker's request for coverage, to avoid any potential gaps. The correct answer is C. Conduct a detailed factual investigation into the nature of the worker's relationship with the business, focusing on factors such as the degree of control exercised, the worker's opportunity for profit or loss, and their investment in the work, to determine if they meet the criteria for an employee under the applicable laws. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the immediate need to provide accurate workers' compensation benefits with the long-term implications of misclassifying an employee, which can lead to significant financial penalties and reputational damage. The core of the challenge lies in interpreting the nuances of employment relationships within the context of the CIC Commercial Casualty Institute exam's regulatory framework, which emphasizes the employer's responsibility for ensuring proper coverage for all eligible employees. The correct approach involves a thorough investigation into the nature of the worker's relationship with the business, focusing on the degree of control the business exercises over the worker's activities, the worker's opportunity for profit or loss, and the worker's investment in equipment or materials. This aligns with the regulatory framework's emphasis on substance over form when determining employee status for workers' compensation purposes. Specifically, the framework often looks to common law tests or statutory definitions that prioritize factors like supervision, method of payment, and the permanency of the relationship. By diligently gathering and analyzing these facts, the underwriter ensures that the correct classification is made, thereby guaranteeing that the worker receives the appropriate benefits if injured, and that the employer complies with their legal obligations. This proactive risk assessment is crucial for preventing future claims disputes and regulatory noncompliance. An incorrect approach that relies solely on the worker's self-declaration of independent contractor status fails to meet the regulatory standard. The law generally does not permit parties to unilaterally define an employment relationship in a way that circumvents workers' compensation obligations. This approach ignores the regulatory body's mandate to protect workers and ensure fair compensation, potentially leading to underpayment of premiums and denial of benefits. Another incorrect approach, which is to assume employee status based on the worker's request for coverage without further investigation, is also problematic. While it errs on the side of caution regarding coverage, it may result in the employer paying for coverage that is not legally required, leading to unnecessary premium costs. This demonstrates a lack of due diligence in assessing the actual employment relationship and can be seen as inefficient risk management. Finally, an approach that dismisses the classification issue because the worker has not yet been injured is fundamentally flawed. Workers' compensation laws are preventative and protective. They require employers to secure coverage for all employees regardless of whether an injury has occurred. Delaying classification until an incident arises is a direct violation of the spirit and letter of the law, exposing both the employer and the insurer to significant risks. Professionals should employ a systematic risk assessment process that begins with understanding the specific definitions and tests for employee versus independent contractor status as defined by the relevant regulatory framework. This involves gathering detailed information about the working arrangement, applying the established criteria objectively, and documenting the decision-making process. When in doubt, consulting with legal counsel or regulatory experts specializing in workers' compensation law is a prudent step to ensure compliance and mitigate potential liabilities. Question 17. Cost-benefit analysis shows that denying a claim under coverage A, bodily injury and property damage liability for a minor property damage incident, based on a broad interpretation of a care, custody, or control exclusion, would save the insurer significant immediate expenses. However, the policyholder argues that the exclusion is not applicable given the specific circumstances of the incident, which involved temporary and incidental control of the property. What is the most appropriate approach for the underwriter to take? Option A. Deny the claim based on the cost-benefit analysis, as the exclusion clearly presents an opportunity to reduce immediate payout and associated claims handling costs. Option B. Inform the policyholder that the exclusion is standard and will be applied to deny the claim, suggesting they seek recourse through other means if they disagree. Option C. Immediately approve the claim to avoid potential disputes and regulatory scrutiny, regardless of the exclusion's potential applicability, as the incident involves only minor property damage. Option D. Conduct a detailed review of the policy's care, custody, or control exclusion, relevant state statutes, and case law to determine if the exclusion is truly applicable to the specific facts of the incident before making a coverage decision. The correct answer is A. Deny the claim based on the cost-benefit analysis, as the exclusion clearly presents an opportunity to reduce immediate payout and associated claims handling costs. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the immediate financial implications of a policy decision against the long-term implications of regulatory compliance and the insurer's duty to its policyholders. The CIC Commercial Casualty Institute exam emphasizes understanding how coverage A, bodily injury and property damage liability, is applied in real-world underwriting, particularly when faced with competing pressures. The challenge lies in ensuring that the chosen approach not only meets the insurer's profitability goals, but also strictly adheres to the regulatory framework governing commercial casualty insurance, which prioritizes fair treatment of insureds and adequate protection against covered losses. The correct approach involves a thorough review of the policy's specific exclusions and limitations as they relate to the reported incident, coupled with a diligent application of coverage principles. This means assessing whether the incident falls within the scope of coverage, as defined by the policy and relevant state statutes, and if any exclusions or limitations are applicable and properly invoked. The insurer must act in good faith, providing a clear and accurate coverage determination based on the facts and the policy language, without resorting to arbitrary or self-serving interpretations. This aligns with the regulatory expectation that insurers will honor their contractual obligations and operate transparently. An incorrect approach would be to prioritize cost savings by broadly interpreting exclusions or limitations to deny coverage, even when the incident arguably falls within the policy's intent. This could lead to regulatory violations related to unfair claims settlement practices or bad faith, as it fails to uphold the insurer's contractual promises. Another incorrect approach would be to automatically assume coverage without a proper investigation, potentially exposing the insurer to significant financial risk for claims that are not intended to be covered. This demonstrates a lack of due diligence and a failure to manage risk effectively, which can also have regulatory consequences. A third incorrect approach would be to delay the coverage determination process unnecessarily, which can frustrate the policyholder and potentially violate regulations concerning timely claims handling. Professionals should approach such situations by first establishing a clear understanding of the policy's terms and conditions, particularly coverage and any relevant endorsements or exclusions. This should be followed by a comprehensive factual investigation of the incident. The next step is to apply the policy language and factual findings to the relevant state insurance regulations and case law. Finally, the insurer must communicate its coverage decision clearly and promptly to the policyholder, providing a detailed explanation for its determination. This systematic process ensures that decisions are well-reasoned, compliant, and ethically sound. Question 18. The control framework reveals that a commercial client, operating a manufacturing facility with significant product liability exposure, currently holds primary commercial general liability policies with limits of $1 million per occurrence / $2 million aggregate. The client's risk management team has expressed concern about potential large-scale product recalls or widespread product liability claims that could exceed these limits. The insurance broker is tasked with recommending appropriate excess liability coverage. Which of the following approaches best aligns with regulatory expectations for advising on umbrella and excess liability insurance? Option A. Conduct a thorough review of the client's primary commercial general liability policies to confirm their terms, conditions, and aggregate limits, and then recommend an umbrella liability policy that provides coverage in excess of the confirmed primary limits, ensuring it is structured to address the client's specific catastrophic loss exposures. Option B. Advise the client to increase the limits of their primary commercial general liability policies to $5 million per occurrence / $10 million aggregate, and then suggest a $5 million umbrella liability policy. Option C. Recommend a $10 million umbrella liability policy that will provide coverage above the $1 million per occurrence limit of the primary policy, assuming the primary policy is adequate. Option D. Place a $15 million umbrella liability policy directly over the client's operations, without first verifying the specific terms and limits of the underlying primary policies. The correct answer is C. Recommend a $10 million umbrella liability policy that will provide coverage above the $1 million per occurrence limit of the primary policy, assuming the primary policy is adequate. Explanation: this scenario presents a professional challenge because it requires an insurance broker to navigate the complexities of commercial liability coverage, specifically the interplay between primary and excess/umbrella policies, while adhering to regulatory requirements for policy placement and client advice. The broker must ensure the client's coverage is adequate and compliant, which involves understanding the limits, conditions, and exclusions of each policy layer. The core of the challenge lies in accurately assessing the client's risk exposure and recommending a coverage structure that meets both legal and business needs, without misrepresenting the coverage provided. The correct approach involves a thorough review of the client's existing primary liability policies to ascertain their limits and terms, followed by an assessment of the client's potential for catastrophic loss. Based on this analysis, the broker then recommends an umbrella policy that provides coverage above the primary limits, ensuring it is structured to respond appropriately to claims exceeding the underlying coverage. This approach is correct because it directly addresses the regulatory expectation that brokers act in the best interest of their clients, providing advice and solutions that are suitable for their specific risk profile and that comply with applicable insurance laws, such as those requiring adequate and appropriate coverage. It demonstrates due diligence in understanding the client's needs and the available insurance products. An incorrect approach would be to simply recommend an umbrella policy with a high limit without first verifying the adequacy of the underlying primary coverage. This fails to acknowledge the fundamental principle that umbrella policies are excess coverage and will not respond until the primary limits are exhausted. This could lead to a significant coverage gap for the client, exposing them to uninsured losses and violating the broker's duty of care and potentially specific state regulations regarding policy placement and advice. Another incorrect approach would be to assume the client's existing primary policies are sufficient and to place an umbrella policy that merely adds a layer of coverage without considering potential exclusions or conditions in either the primary or umbrella policies that could limit or deny coverage. This oversight could result in a false sense of security for the client and a failure to provide comprehensive risk management advice, which is a regulatory and ethical failing. Finally, an incorrect approach would be to recommend an umbrella policy that is not properly coordinated with the primary policies. For example, by having different terms or conditions that create gaps or ambiguities in coverage. This demonstrates a lack of understanding of how layered liability policies function and a failure to ensure seamless protection for the insured, which is a breach of professional responsibility. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand the client's business and risk exposures. 2. Review all existing insurance policies, paying close attention to limits, deductibles, exclusions, and conditions. 3. Assess the potential for catastrophic losses and determine appropriate coverage limits for both primary and excess layers. 4. Research and recommend insurance products that best meet the client's needs and regulatory requirements. 5. Clearly communicate the terms, conditions, and limitations of all recommended coverage to the client. 6. Document all advice and decisions made throughout the placement process. Question 19. Research into condominium insurance scenarios reveals a situation where a fire originating in a unit causes significant damage to the unit's interior finishes, fixtures, and the unit owner's personal property. The fire also spreads to adjacent common elements, including a portion of the building's exterior wall and a common hallway. From the perspective of the CIC Commercial Casualty Institute, exam's regulatory framework, which approach best delineates the insurance responsibilities for this loss. Option A. The condominium association's master policy is responsible for covering the damage to the unit's interior finishes and fixtures and the damaged common elements, while the unit owner's individual policy is responsible for their personal property. Option B. The unit owner's individual policy is responsible for the damage to the unit's interior finishes and fixtures and their personal property, while the condominium association's master policy is responsible for the damaged common elements. Option C. The condominium association's master policy is responsible for covering the damage to the unit's interior finishes and fixtures, the unit owner's personal property, and the damaged common elements. Option D. The unit owner's individual policy is responsible for covering the damage to the unit's interior finishes and fixtures, the unit owner's personal property, and the damaged common elements. The correct answer is C. The condominium association's master policy is responsible for covering the damage to the unit's interior finishes and fixtures, the unit owner's personal property, and the damaged common elements. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the distinct insurance responsibilities between a condominium association and individual unit owners, as defined by the CIC Commercial Casualty Institute exam's regulatory framework. Misinterpreting these roles can lead to significant coverage gaps, disputes, and financial liabilities for all parties involved. The core challenge lies in accurately identifying which party is responsible for ensuring specific perils and property interests, especially when damage affects both common elements and individual units. Correct approach involves recognizing that the condominium association's master policy is designed to cover the walls-in of individual units, including fixtures, improvements, and alterations made by the association or previous unit owners, as well as all common elements. Unit owners, in turn, are responsible for ensuring their personal property and any upgrades or additions they make to their units beyond the standard finishes provided by the association. This aligns with the principle of avoiding duplicate coverage while ensuring comprehensive protection for all insurable interests. The regulatory framework for condominium insurance, as tested by the CIC Commercial Casualty Institute exam, emphasizes this division of responsibility to prevent uninsured losses and to clarify the scope of each policy. An incorrect approach would be to assume the condominium association's master policy covers all damage to individual units, including personal property and upgrades made by the unit owner. This fails to acknowledge the unit owner's responsibility for their personal contents and any enhancements they've made, leading to a coverage gap for those specific items. Ethically and regulatorily, this is unacceptable as it misrepresents the scope of coverage and can leave the unit owner exposed to financial loss. Another incorrect approach is to assume that unit owners are solely responsible for all damage within their units, including structural elements and fixtures that are typically part of the association's master policy. This ignores the association's obligation to ensure the building's structure and common elements, potentially leading to the unit owner being billed for repairs that should be covered by the master policy. This creates confusion and potential disputes over responsibility and payment. A third incorrect approach is to focus solely on the perils that affect the building's structure, without considering the distinct coverage needs for personal property and interior upgrades within the units. This overlooks the comprehensive nature of condominium insurance, which requires addressing both the building's integrity and the unit owner's personal possessions and improvements. The professional decision-making process for similar situations should involve a thorough review of the condominium association's governing documents, declaration, bylaws, rules, and regulations, and the specific insurance policies in place. Understanding the definitions of unit, common elements, and limited common elements is crucial. Professionals must then apply the principles of risk management and insurance to determine the appropriate allocation of coverage responsibilities between the association and individual unit owners, ensuring that all insurable interests are adequately protected without unnecessary duplication. This requires a deep understanding of the CIC Commercial Casualty Institute exam's curriculum on condominium insurance. Question 20. To address the challenge of determining coverage for an employee's lawsuit against their employer following a workplace injury, an insurance adjuster reviews the claim. The employee is alleging negligence by the employer in maintaining a piece of machinery that led to their injury. The adjuster knows that the employee has filed a workers' compensation claim for the same injury, and benefits are currently being paid. Based on the CIC Commercial Casualty Institute exam's regulatory framework for commercial casualty insurance, which of the following approaches is the most appropriate for handling this claim under coverage B, employer's liability? Option A. Offer a settlement under employer's liability to avoid litigation costs, even though workers' compensation benefits are being paid. Option B. Deny coverage under employer's liability, citing the exclusive remedy provisions of the applicable state's workers' compensation law and the policy's exclusion for bodily injury to an employee if benefits are required to be paid under a workers' compensation law. Option C. Provide coverage under employer's liability because the employee has filed a lawsuit against the employer for a work-related injury. Option D. Investigate the employer's potential intentional wrongdoing that may have caused the injury, as this could trigger employer's liability coverage regardless of workers' compensation. The correct answer is C. Provide coverage under employer's liability because the employee has filed a lawsuit against the employer for a work-related injury. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how Coverage B of the Commercial General Liability (CGL) policy, specifically employer's liability, interacts with state workers' compensation laws and the potential for dual coverage claims. The challenge lies in correctly identifying when an employee's injury falls under the exclusive remedy provisions of workers' compensation and thus is excluded from employer's liability coverage, versus when it might trigger employer's liability due to a third-party action or a specific exception. Misinterpreting this distinction can lead to improper claim denial or coverage disputes, impacting both the insured employer and the injured employee. The correct approach involves a thorough review of the claim facts against the specific wording of Coverage B and the applicable state's workers' compensation statute. Coverage B typically responds when an employee sues the employer for a work-related injury, but only if the suit is not barred by workers' compensation exclusivity. This includes claims for bodily injury to an employee arising out of and in the course of employment, provided the employee is not entitled to workers' compensation benefits or if the injury is caused by the employer's intentional wrong. The regulatory framework for the CIC Commercial Casualty Institute exam emphasizes adherence to policy language and statutory limitations. Therefore, verifying the employee's entitlement to workers' compensation benefits is paramount. If benefits are being paid or are available under the state's Workers' Compensation Act, the claim for employer's liability is generally excluded under the Coverage B employer's liability exclusion, which states it does not apply to bodily injury to an employee if benefits for that injury are required to be paid under a workers' compensation, non-occupational disability, or occupational disease law. An incorrect approach would be to automatically grant coverage under employer's liability simply because an employee is suing the employer for a work-related injury. This fails to recognize the primary and exclusive nature of workers' compensation benefits for most work-related injuries. Such an approach violates the policy's exclusions and the intent of workers' compensation statutes, potentially leading to the insurer paying for claims that are statutorily excluded. Another incorrect approach is to deny coverage solely based on the fact that the injury occurred during the course of employment, without investigating whether workers' compensation benefits are available or have been claimed. While workers' compensation is the primary remedy, there are specific circumstances where employer's liability might apply, such as intentional acts by the employer or situations where the employee is not covered by workers' compensation for some reason. This approach risks improperly denying a valid claim. A third incorrect approach is to assume that any lawsuit filed by an employee against an employer for a work-related injury automatically falls under employer's liability coverage, regardless of workers' compensation. This ignores the fundamental principle that workers' compensation is designed to be the exclusive remedy for most workplace injuries, thereby circumventing the policy's exclusions and the statutory intent of workers' compensation laws. The professional decision-making process for similar situations should involve a systematic review. First, confirm the injury is work-related. Second, determine if workers' compensation benefits are applicable and available under the relevant state law. Third, if workers' compensation applies, assess if any exceptions to exclusivity or specific triggers for employers' liability coverage exist within the policy or statute. And finally, make a coverage determination based on this comprehensive analysis.